is temporarily closed for repairs. The credit crunch has, well, crunched credit, and entrepreneurs are wondering how to find their way to the fundraising finish line.
Looking to raise funds for your dream venture? Well, you have to be an experienced driver to navigate your way out of this economic jam. That means investors are no longer willing to bet on a venture that's just getting into first gear. They prefer companies that have already gained some speed.
Ask Sudhir Sethi of IDG Ventures. Back in 2007, IDG did invest in startup companies like healthcare innovator Perfint and advertising company Ozone Media. But
in this year, would we invest in a seed investment? Unless it's out of the ordinary, very extraordinary, backed by a stupendous team, that will be difficult for us. We would invest in companies where the first go-to-market has already transpired. First customer has been acquired so that the proof of concept is already there.
Well, even those that meet the description aren't zipping along. Meet Rakesh Antala. He runs Crederity, a credential checking agency that he set up way back in 2004. He tried raising money last year when the company had bagged steady clients and was already generating revenues. But getting funded wasn't quite the smooth ride he thought it would be. It took the company close to 7 months to complete the process, double the time they had anticipated.
Obviously, in the current time, the investors are very watchful and cautious about where they're putting their money in. So due diligence obviously is going to take twice as much time.
Twice as much time and twice as many disclosures. Investors are also inserting special clauses to guard against unforeseen events. For example, in the case of product companies, many term sheets now make it mandatory for the entrepreneur to buy back the investor's stake in case the product doesn't take off in a fixed period of time. Others are asking the entrepreneur to ensure that he won't need any more capital infusion for 6 to 12 months.
When we invest, we're saying, okay, we'll put in the X, but if 6 months later you come back and say you need 2X again, then we're not willing to put in the X also.
And many are double checking every contract and agreement that the company has signed.
Say for example, somebody is doing a contract where there are other institutions who are going to be participating from the perspective of vendors. They want those contracts also on the board. The investor is saying that why don't you get a MOU or some kind of a binding agreement signed with them that they are going to participate in your venture in India.
And most investors are no longer happy simply guiding or advising their portfolio companies. They prefer backseat driving.
English language training company Speakwell, for instance, managed to raise funding from angel investors this year. But they got more than just money.
There was no terms like review on a monthly basis. Now the plans get reviewed on a monthly basis. There's a board of director. There's a person on the board who is actively involved in the company in terms of review and understanding the plans. Which I guess 6 months back we had a clean sheet in terms of what we wanted to do with the money and how we wanted to go about, what kind of risk we wanted to take.
Lower valuations, more disclosures, investor participation in management. If fundraising via equity is driving you crazy, do what Pagal guy Alwyn Agnell did. The founder of India's largest education site turned to debt.
For two reasons. One is we needed the money sooner. A venture round would have taken somewhere around 6 months to close, while debt we were able to raise in 2 months. And second, I think we were extremely sure about our business proposition that we were able to convince a bank to lend us money without collateral.
We would have plenty of loans where there is no collateral. But like SIDBI, there has floated a scheme known as a credit guarantee trust for micro and small enterprises, CGT MSE, under which they provide guarantee for bank loans. If the loan is up to 50 lakh, they provide 75% guarantee. For loan between 50 lakh to 1 crore, they provide 50% cover.
While equity investors are clamping down on terms and conditions, banks say they have many concessions lined up. For example, they're willing to lend up to 85% against stocks and receivables as against the 75% limit of a few months ago. They can also give you an additional 20% of working capital limits as a demand loan repayable within a year.
But if equity is going to cost you time, effort and your management independence, debt comes at a hefty 10 to 15% interest cost. and only companies already on the road to profitability can afford that. And besides, no matter who fuels your venture, only a robust vehicle and a detailed roadmap will help you speed your way to success. In Mumbai, Isha Dalal.